This is part 2 of our chapter 4 video lecture series, where we continue with the topic here called fringe benefits. Keep in mind that the first half of chapter 4 deals with exclusions, tax-free income. Now, just because you receive fringe benefits from your employer, that doesn't mean it's tax-free. For example, you receive vacation pay or sick pay or a bonus. All of that is taxable income that will be included on your W-2 form. But here, we'll see some examples of fringe benefits that may be tax-free to the employee. Keeping in mind that typically to make it tax-free, it has to be part of a program of the employer that does not discriminate in favor of what they call key employees, who could be owners of the company or highly paid employees of the company. So you pretty much have to provide this type of fringe benefit program to employees across the board to make it tax-free to the employees. So again, an example of one we've seen before is when the employee is covered with health insurance. Of course, the cost of that is going to be paid by somebody, hopefully the employer, and that payment to the insurance company is called a premium. Typically, that premium payment is a tax-free benefit to the employee. Of course, the payment of any type of healthcare cost by the insurance company should be tax-free. I believe here in Hawaii, if the employee works more than 20 hours a week, the law requires the employer to cover that employee with health insurance. It doesn't mean that they're going to pay for the full amount of the health insurance, but at least there's a formula. It may come to a minimum benefit of probably 50% of that insurance payment, and the employee may pay the other half. Another benefit that may be tax-free is if the employer pays for dependent care for that employee to take care of their children or other dependents so they can come to work. The maximum benefit is $5,000 a year. Now, if you remember back in chapter 2, we talked about a tax credit called Child and Dependent Care Credit, and we can use that credit to offset the tax. Well, here, if you receive this tax-free benefit, you cannot use this money to offset the costs that now can be used for the credit. You either are taking this tax-free benefit or you have costs that you can use for the credit and not a double benefit. Let me show you a situation where maybe if you are not covered fully by health insurance or you don't receive a benefit like this from your employer but you need it, how you can possibly arrange, if your employer allows it or if they have a program, to reduce your taxes. So let's start off with a blank screen here. So here is the employer, ER, probably paying a wage or salary to the employee. And of course, we know this is a taxable benefit you get when you work. And our employee needs some type of health care. So typically they go to see a healthcare provider like a doctor, a dentist, pharmacist. And of course, we have to pay the bill for that health care. Hopefully, our employee is covered with health insurance. So let's have a health insurance organization over here, a health insurance company. The big one here in Hawaii is called HMSA and Kaiser Permanente. So hopefully they'll cover most of that healthcare costs. And the cost the employee pays, hopefully a smaller amount, is called the deductible co-payment. Now, the healthcare insurance costs money. So hopefully your employer pays that so-called premium to the insurance company. Now, this premium is a tax-free benefit to the employee. But many companies require the employee to pay part of that premium too. So they would deduct out of the wage or salary the employee shares and combine it with the employer share. The good thing, if there's any good thing here, is that this premium coming out of the employee's pay is going to reduce the taxable wage or salary to the employee. Now, if the employee makes an election, yeah, it's not automatic. Typically, when you start up a job, you're going to say that you want to reduce the taxable income here by the amount of premium being withheld for health insurance out of the employee's paycheck. So let's say another thing the employee needs is some type of child care or maybe even adult daycare so they can go to work. So here's the fee being paid by the employee. And if the employer pays for it, or if the employer reimburses it to the employee, it's a tax-free benefit. But let's say the employer doesn't have a program to pay that type of cost. If the employer has something called a flexible spending account program, an FSA, what the employee can do is elect to have money taken out of their paycheck to reduce the amount that's going to be taxable to the employee. And then when the employee incurs this type of childcare costs or even this out-of-pocket costs, again, if the employer allows it, they can have the FSA reimburse the employee for that cost tax-free. Again, it was reducing the pay over here, taxable pay, and getting a tax-free reimbursement, either for the childcare costs or for the out-of-pocket medical costs. Okay, that's called here a flexible spending account. And that has to be a program set up by the employer, which many employers like because not only does it reduce the income taxes of the employee, but reduces both the employee and employer's shares of the FICA taxes, the Social Security and Medicare, and maybe even unemployment taxes. Let's continue here in our textbook with the next excludable tax-free amount. We've talked about a tax credit for adoption costs, yeah? So here the employer can, I've never ever seen this, but up to this amount of cost can be paid by the employer tax-free. Again, you cannot claim a double benefit of this tax-free reimbursement and the credit. Here you can see the dollar amount the employer can provide the employee with educational assistance, yeah, to get more education on their own. This does not apply to the employee's spouse or employee dependents. And this, I believe, qualifies only for, well, it applies for both graduate and undergraduate degrees. Okay, so if the education is directly related to the employee's job to make them a better employee, then there's probably no dollar limit. So this kind of reimbursement can apply to any type of class or any type of program that the employee is taking. If you're an employee of a educational institution, then the undergrad tuition costs can be tax-free for the taxpayer and the taxpayer's spouse and the taxpayer's dependents. That's just the tuition costs. Here you can see there's insurance, life insurance that the employer can pay for, called group term life. And the tax-free coverage is up to $50,000. Again, what's really tax-free is the cost of the insurance, again called the premium. And if the coverage is more than $50,000 per employee, then the excess premium paid by the employer could be taxable based upon the age of the employee. And here you can see how much additional coverage in increments of 1,000. And this is the amount per month that you now have to report as additional income to the employee. Other fringe benefits, if you go to a gym and your employer reimburses you for the membership cost, that's a taxable benefit. But if the employer allows you to use their athletic facilities on their premises, usually that's a tax-free benefit. So here's a benefit a lot of employees look forward to, getting discounts from their employer for goods, merchandise, even services that they buy from the employer. Now, if what they're getting from the employer is a service, the maximum discount they can get tax-free is 20%. So if you give your employee more than that, the excess is taxable. In the case of merchandise that's being sold by the employer to the employee, the discount can be all the way down to just charging the employee the cost to the employer. In other words, as long as the employer is not making a profit when they resell that good or merchandise to the employee, that's going to be a tax-free benefit. If they sell it below the cost of the employer, now that extra amount is going to be taxable. Somewhat related to, again, getting things at a discount from your employer is if the service provided by the employer doesn't cost the employer any additional costs. The typical example would be an airline employee being able to jump on a standby seat. You're not bumping any passenger, and it doesn't really cost that much more to fill up that seat with an employee. Or I guess another example is maybe the use of a hotel, yeah, a vacant room. Meals and lodgings provided by the employer to employees, as long as it's for the convenience, for the purpose of what the employer wants and not just a benefit to the employee, this can be a tax-free benefit. So the main thing here is that you're trying to motivate the employee to stay on campus, to stay within the building. In the case of, we understand maybe in the case of nurses and doctors, medical personnel, we want them to stay at the hospital just in case there's an emergency, makes them easier to reach. Or the real logical one would be firefighters. Yeah, we want them to stay at the fire station to get ready to go out in case there is a fire. Moving expenses used to be deductible if it was paid by the employee. No longer. Also, if you get reimbursed by your employer for moving expenses, that's just additional taxable compensation. An exception would be possibly for people in the armed services. There's a dollar amount employers can provide for parking, for um, for I guess in our case maybe bus transportation. Here, this $265 per month. Again, tax-free benefit. A working condition benefit is just additional costs that would be paid to make the employee a better employee. For example, things like professional membership dues, professional journals or magazines about the industry that they're working in. Those can be tax-free costs paid by the employer. If you get counseling for retirement paid by employer, that's a tax-free benefit. Here, this word, the term de minimis, a Latin phrase meaning too small, too many to worry about, that's tax-free. Examples to use here is stuff like using the photocopier in your office or small gifts for the holidays. Okay, let's stop here, and when we continue, we'll take a look at more excludable or tax-free benefits.